Hi, I'm Bill Baruch, president of Blue Line Capital, and I'm here with our analyst, Jannis Meindl. And this is the Triple Play podcast where we bring you a great macro overview in three stocks, different three stocks every week that we cover. So we got a great one for you this week. Jannis, why don't you start us off with the macro?
Yeah, thanks, Bill. Welcome back, everybody. So the theme really this week from my side is if we think about the world in terms of different asset classes and the yield that you can earn on them, then you definitely have the option of going with stocks, but you also have the option of going with bonds. And the relative yield on the two is really how you make that trade-off. And if we look at today's inflation regime, a lot of people have looked towards the 2-year yield, about 5% today. And what does that mean in terms of earning a risk-free return on that versus being in equities or maybe corporate bonds, maybe high yield bonds, and earning the same return, but there are a little bit more variables to that because you need to consider that you have duration on these assets, whereas you lock in a 5% yield for 2 years, you lock in that residual cash flow on the equities, and you lock in a much higher duration on the corporate bonds, although they might not be looking too attractive here in terms of yield, but there are these two components. So I think that's important to think about in terms of capital allocation, how you think about this from an investment perspective. And then just in terms of the overall health of the credit markets, as we look at spreads and we turn to leveraged loans, leveraged loans are basically one of the more volatile aspects of the credit markets. And if there was a lot of risk in the system, then that would definitely be a place where it shows up. But the fact of the matter is that leveraged loans have rallied also in inflation hedge to an extent because these yields are variable rather than fixed. But if there was a lot of stress, then you would definitely see it in some of these areas first. And then if we look at overall deal activity and whether there's a sufficient underpinning for activity to return if the macro picture becomes a little bit more certain. We'll look at dry powder from private equity funds and the private equity markets in general. You see that there's tremendous capital that's not called yet. So as soon as things stabilize, you can expect quality deals to pass and maybe some of the lower quality deals to pass too. So it's really all comes down to data dependence. How does the data shake out? And Bill, you'll touch on some of that. But there is definitely a good underpinning in case things do settle down a bit. And that's as far as my part goes for today here on the macro side.
Yeah, great stuff, Jannis. It's definitely something that not everybody's thinking about every single day, and it's it's really the very very intricacies of the economy, what's keeping things rolling. But what people are talking about every day is what's in the headlines, and what's in the headlines today is Fed Chair Powell. He had his congressional testimony, really slammed markets, talking about the interest rates probably if the data continues to be hot, hiking more and staying up there longer in order to subdue inflation and that continued battle with inflation. It's definitely a different Powell today than we've heard in January, February. And this is the Powell that I was thinking we were going to hear February 1st at the Fed meeting, potentially even the following week I think it was the Brookings Institute that he spoke at, or the Economic Club of Washington that he spoke at. He had a chance to sort of redo the FOMC, and he didn't. He stayed that disinflation course all through the early part of February. I didn't hear disinflation at all today. And that really describes it right there. We've seen the probabilities of a 50 basis point rate hike later this month jump to almost 70%. It's kind of settled in there in the mid 60s. So before today started, a 50 basis point rate hike with the probability of 30 basis points. He ultimately, markets were slammed down. The 2-year yield got up to 5%. We're seeing the inversion of the 2s and 10s approach, if not already hitting negative 1%. This is some pretty extraordinary stuff that we're seeing here today, especially to see Powell flip to become this hawkish ahead of the data. I mean, the Fed's data dependent, really not a whole lot of reason to see him flip this hawkish ahead of was non-farm payroll Friday, ahead of CPI next week. And at the end of the day, this data is going to be what drives the markets. And the trend is really, there is none. There is no trend. We had one really hot jobs report for January that came out in early February. What kind of distortions are we going to see? We've been seeing pretty wild revisions across the board. So stay nimble. I wouldn't be surprised to see anything, but given what we're almost beginning to see is Powell as a contraindicator of sort of the Economist magazine style. Talk about disinflation in January, early February, now getting hawkish on inflation. what if this jobs number comes in a little bit, revision? So stay nimble. We'll see what comes. But the week is just getting started. So let's jump in, though. We're just getting started here. We'll jump in. We got our first name for you in Schlumberger. This is a name that we added last week. We wanted to get some energy exposure back on. One of our fears. We had Pioneer. We cut Pioneer Natural Resources a couple of weeks ago. Not that we don't like the company. It's a very, very well-run company. And we'll probably cover that here in the coming weeks. But it's very tied to the price of oil. Where Schlumberger, is an oil services company. And, we really like being in that space right now. I think it's definitely had shown some leadership within the energy space in the past few months. We'll show that in a chart later. But one of the things here is oil demand. Despite what the White House is going to tell you, oil demand is not going anywhere. It's only increasing. 2014, 92.7 million barrels per day to 99.4 million barrels per day in 2022. We're going to be above 100 million barrels of oil, global oil consumption. I think really when we come down to it and we look at this, one of the themes that we've talked about quite a bit as well has been underinvestment within the space. And I've talked about that in the future side and why oil prices will stay higher. Schlumberger is right within the middle of that. You look at Schlumberger, Halliburton, Weatherford, Transocean. They have invested 70% less in durable assets since 2014. And then their net property, plant, equipment base has shrunk by 7% annually since 2014 to 2022. Underinvestment is really going to be highlighting what could underpin a longer duration of this oil rally as we consolidate above $70 for now. The interesting thing too that I like about Schlumberger is where they're getting the revenues. 80% of the revenues is from overseas. So I think that diversification, we have a lot of domestic oil exposure, energy company exposure. So that's also great. And looking at that, 32% of the overall revenues are from the Middle East. So there is some competition there, but I think that puts them in a really good spot as well. And sort of where these tend to be regions with long cycle projects that I think we're going to see some, come to fruition here in the next few years. So this is a name that we like to hold. And then, really underpinning, why do we buy it right now? It's within our theme of looking at next 12 multiple that has dropped 18.5 for Schlumberger. Now is next 12 multiple. That's down from 23 from the trailing. It's a little more expensive though than say Halliburton at 12. But I think we're paying for that, what's to come in that company. So I like where we are here. Jannis, what do you got for us on Schlumberger?
Yeah, I would really echo a lot of the points that you made with offshore, with the fact that they have a lot of international exposure. Only 20% of revenue is coming domestically. And then just to drill into what it means to have offshore versus the shale wells that are a lot shorter cycle projects that can be turned on and off. But what does that mean for the company? What it basically means is that it takes a really long time going from exploration to production, ultimately abandoning a project. So exploring these offshore projects can take up to 4 years. And in year number 5, you really get into the drilling. So if you are a Schlumberger, you have these really sustainable long-term contracts, a lot of cash flow visibility. And that's really what accounts for the fact that Schlumberger is trading at a premium multiple to Halliburton, because you have that cash flow visibility with those extensive revenues coming from overseas. If you think about a company like Saudi Aramco and what the additional production is going to come from, a lack of spare production has been a theme for OPEC for more than 2 years, maybe 3 years now. So if you think about that additional production, it definitely seems like they're going to go offshore. They're going to have those more visible contracts for all of the oil services companies. And then you, of course, as you alluded to, with the lack of investment we've seen in the space, with the low capital basis, with the low asset basis that all these companies are dealing with right now. And that's a major reason why a lot of the oil majors are actually complaining that Halliburton, Schlumberger, and Baker Hughes are all charging quite substantial prices when they service all the pioneers, the Chevrons, the Exxons in the Permian Basin. And then in terms of speaking about shale production and speaking about swing producers, you have to think about an additional aspect that will flow into the equation when it comes to offshore and finding that additional swing producers over the course of history, over the course of how oil prices have developed. Oil price really depends on whether there's a swing producer or not, rather than absolute oil demand imbalances, because if you have that swing producer, you can quickly respond to demand increases and reversely also take supply off the market. And it seems like the U.S. is sort of bumping up against increased challenges with oil production. Back in 2019, the U.S. produced almost 13 million barrels of oil a day. That's below 12.5 million today. And what you have to account for is the fact that a lot of the oil majors have really brought in the drilled but uncompleted wells that they're running. So during COVID, when nobody was extracting oil from the ground, there was a lot of inventory that these oil majors still had. And in the process of coming out of the pandemic, as demand came back online, you had a lot of these oil companies sit there with a lot of inventory on the wealth side. But now as that's come down, the question is whether these oil companies can ultimately respond to demand shocks to the upside as much as they were able to recently. But yeah, I think a lot of these signs do point towards offshore, but I'll hand it back to you, Bill.
Yeah. I think look at these charts here, some of the trends that we've been seeing. Good performance in Schlumberger. This is a weekly chart, but kind of looking here, this more centered on the move that we are seeing, getting out above those 2019 highs. So that's pre-COVID. We're talking about pre-COVID, out above those highs now, and I think that's pretty constructive. We did get above the 382 retracement from its record. We're moving potentially to the 50% retracement, which is that 2019 breakdown. So keep an eye on this. I mean, this is, again, we added this name. We really like it. And one of the things that I really think is great too is relative to the XLE. So if you're looking for reversion to the mean, this is going back 20 years. You're seeing SLB relative to the price of the XLE, the energy sector as a whole, not just oil services, but the energy sector as a whole. And oil services relative to the energy sector as a whole has fallen off like the same way, but much sharper in those recent years. So got nice consolidation in prices. It could be a reversion to the mean. Having exposure in a name like Schlumberger, especially if you own other energy companies in the space, if we were to see a slump broadly, maybe Schlumberger will outperform, does not have to underperform the broader market even. There's definitely a lot here to take away from how it is and potentially a reversion to the mean, because sometimes reversion to the mean doesn't have to come through strength. It can come through weakness of the other. So keep in mind here what we could see if we just see sort of some of the other names not perform like they have at that pace, and these oil services companies catch up a bit. So I think that's a really constructive chart. Let's move on. Palo Alto Networks. They reported earnings. Was it last week? I mean, it was terrific. Up or 2 weeks ago. Up tremendously. Now, we don't own Palo Alto. We've owned CrowdStrike on and off since 2021. CrowdStrike actually just reported here today, and they're up about 6% after hours. I haven't really a chance to dive into things, but one of the trends that, like I highlighted with Schlumberger, was highlighted on with others, is the next 12-month multiple higher than the trailing, and that, showing that in this environment, I think that's a healthy thing to be seeing. Palo Alto doesn't have that. I mean, we're looking at next 12 at 44. The trailing is 17. You look at some of these names, the space is very lumpy. I mean, you got, you can see some big swings. Of course, Zscaler was down, I think 20% after reported that might have been early last week. Cisco, their multiple is 12 relative to, you looking at the next 12 relative to Palo Alto. CrowdStrike, I mean, this is before they reported today, the next 12 was 66. I mean, it's a wide range within the space. Obviously, Palo Alto, the upper end of it, but not the high as the others. Here's the thing: is you have a lot of buzz, especially coming out of the pandemic, but also as companies transition to work at home environments, but also as the Ukraine and Russia war accelerated, and potential hacking and cybersecurity. It's been a big buzz, and a lot of forward sort of forward movement has been priced into these names, and that is a concern. But I mean, they remain constructive nonetheless. I think that is one of the things that looking at a free cash flow yield relative to its peers, Palo Alto is at a 35 right now, and that's down from 41 in 2019. But their market cap has tripled over that 3-year time frame, 4-year time frame. So seeing that free cash flow yield hang there, that is a reason that I would use to be buying this name. We look at something like it's 35 right now relative to I think CrowdStrike's a 30, and so is Cisco, right, hanging right there at around a 30 or 28. I think Cisco's 28. So they're better free cash flow yields at Palo Alto. It's something to take away as a very good positive in this sort of little bit of a higher, obviously a higher growth name. So I mean, we like it. We don't own it. It's definitely a place that it's on our buy list. We're looking for reasons to be buying it. Jannis, what do you have on this name?
Yeah, talking about buzz around the space, there's definitely been a lot of that with the Ukraine invasion or the Russian invasion of Ukraine, and also around national security in general. There seem to be increased efforts to work between private and the public sector in terms of working together against national security threats, especially in and around China, North Korea, Iran. So a lot of activity in the space, and it's definitely going to increase in relevance because as more data transitions onto the cloud into virtual environments, that ultimately means that the cost of data breaches also goes up. So it will be a theme. It will be something to keep in mind. And if you look at something like the cost of what an average data breach costs today, it's increased by about 3x since 2006. So the cost of data breaches has gone up. It is expected that the space will keep growing. McKinsey estimates that the entirety of the data breaches will cost companies about $10 trillion in 2025. I'm skeptical about that number, but in general, Gartner, a research firm, is talking about $260 billion in spending by 2026, and that's growing at about 11%. So a lot of activity in the space, as I talked about, it's increasing in geopolitical relevance. It was in the White House's national security strategy as one dedicated page. So a lot of activity, relatively high multiple compared to the market. You got to know what you're paying for. One key theme with Palo Alto that the management highlighted as well is that consumers are increasingly looking for more integrated, more consolidated solutions rather than having all different contractors spread out all over the place. So the higher value contracts are picking up in pace, above $1 million, above $5 million, and above $10 million. So that is a tailwind towards Palo Alto, especially as they provide the hardware and then also the software integration that you may not get with a CrowdStrike, for instance. They're purely on the software side. But yeah, a lot of different cross currents. I don't have a strong opinion on the name at the moment, but definitely one to keep on our minds as we move forward here.
Yeah, I use buy list loosely. There's always names in my buy list. Got to have things that you're looking at, things you're watching, things you're finding attractive. Look at the chart here. It's been a big move, good move, moving into some of the high recovery part of last year. This is the weekly, but over a shorter time frame. We broke a downtrend line, nice move, and this is also where it really started falling off last year. Remember the cybersecurity names with the onset of the Russian war. Really surged pretty nicely out of the hole there. So there is an interesting level. It's a bit of an inflection point, definitely some overhead resistance, some supply, if you will, that it's trading into. It'd be interesting to see. We get CrowdStrike up 6% after the close today. The market's down here today, but what if things bounce back? You could see a nice underpinning on with these cybersecurity, given CrowdStrike and how their earnings in Palo Alto in general. So as we move on, Uber is our final stock. It's a name we added. Before I jump into it, remember there is a great chart book here. We do a great job. Jannis, he spearheads that. Just don't hesitate to check out the chart book. Download it. If you have questions on it, reach out to us. We would love to hear from you. So it's a great chart book there with a lot of slides. It's really best to kind of digest a little bit on your own, not just while we're talking about it too. So again, any questions, don't hesitate to reach out. Uber, it's a name we added. We added this name on Friday. We were looking for some stability in the market. Obviously, we didn't get the stability today in the market, but Uber finished positive despite the market really pulling back sharply. I think when we take a step back, this is a company that really a decade ago didn't exist, and where they've come now is I think is something huge. I mean, 10 years ago they operated in 8 cities. Now they do 21 million trips a day. 124 million paying active customers, 70 countries in 10,500 cities. But here's the thing: it's really growing into a well-rounded company, and it's not just focused on ride share. I mean, heck, my Uber bill though, ride shares between traveling Chicago and New York and whatnot has been it's been something else. So I have no reason to be buying this stock as it is. But ride hailing, ride sharing, food delivery, package delivery, that last mile, that's something I think is really important to take a look at. Last mile delivery, it accounts for 41% of a parcel's overall supply chain cost. And last mile delivery accounts for 53% of a parcel's total shipping cost. If Uber really breaks in, they already have, if they really get into this last mile delivery, that's something that can take it to the next level. Freight transportation solutions, year over year annual growth since 2017 to 2022, 153% annual compounded growth rate in freight. I mean, talk about diversified business models. We've been talking about this on the show since we started. We like looking at companies. Two things that really stand out to us: diversified business revenue streams, business model, and as well the next 12 multiple significantly lower than that previous 12 in this environment. But Uber has this really diversified revenue stream, and it's just something that's terrific. It's becoming a very well-rounded business. And then that free cash flow yield. Go back to 2019, it was negative 3.6. Currently, it's going positive 1.9. Revenue estimates are increasing 16.5% this year, 18% in 2024, and then listen, the earnings per share is expected to go positive next year. That's all you have to know. I think there's a lot of upside here with this. Jannis, I'll let you dive into it, and I'll finish it off with the chart.
Yeah, thanks, Bill. And a lot of the points made right there. I think you don't even have to look beyond U.S. borders here to see a lot of opportunity with this name. And it's nice to see that visibility where the next catalyst is going to come from, even beyond as they go cash flow positive, which they are currently in the process. And so it's definitely a good business model that's in development, work in progress, but a lot of good work in progress, I'd say. So in terms of the platform, the Uber platform is extremely strong. They have, you mentioned 124 million riders on their app. They have 12 million Uber One subscribers right now. Those are sticky subscribers. Uber One subscribers make up 25% of gross global bookings, and they tend to spend 4 to 5x of what the standard consumer spends on the app. So you have that subscription model, that recurring revenue model. You have them moving into the freight business, which is a gigantic industry. You think about Amazon, FedEx, UPS, and especially that last mile delivery, which is really a key challenge for companies like an Amazon that have to pay the UPSs, the FedExes, and the postal service to deliver that package on the last mile. And then I think another aspect that you need to pay real close attention to with this name, and again, I connect that to an Amazon. Amazon back in 2017 had about $4 billion in advertising revenues, and they really took a step up with the advertising business. Right now, that's a $40 billion annual revenue business. And what is that a result of? That's a result of merchants and businesses really shifting to the digital platform. And if you have a network, if you have a platform, an app like Uber has, with a lot of people on the app with the necessary supply of drivers, of delivery guys, and then the necessary demand from all the people who write and use the app, you have that real business model where advertisers will want to go to. And even looking beyond the food delivery, looking to groceries and a whole other variety of businesses that they might push into, that could definitely be a goal for them. And they laid it out in their earnings call. Right now, they generate about $500 million in annual advertising revenue, and they plan on getting to about $1 billion by 2024. So you have advertising, you have freight, and you have their mobility and delivery business delivering strong here. Then I think if we just look back towards the quarter that Lyft had, there were a lot of problems there. So you even see some consolidation in the space. So achieving operational excellence is tough in this space, but once you get to that point where you flip cash flow positive, I think that's why you really get to leverage your network a lot more than they might have in the past, and that's why the stock's been flat since their IPO. So yeah, I think we covered a lot of the most important points with this name. I'll let you wrap it up here with the chart, Bill.
Yeah, and I focus a little more shorter term in this chart because I think it's at a really great inflection point. You're seeing this come out of the bottom, got this sort of inverse head and shoulders that took place since the start of last year, bottoming out really nicely, building this right shoulder in the quarter four, and ultimately, yeah, we broke this downtrend line, this is sort of intermediate downtrend line since the end of the first quarter last year, and it's back testing it. It's holding 382 from the low late last year. It's at a pretty important level here. This is the 50-day moving average. So usually we try to give you a little bit longer term chart. Very big inflection point here, $32 or so. Hold out above there. It's a buy in our book. We added it on Friday. We really like the name. We'd love to find reason to add to the name and hold it long term. So we'll leave you at that. A lot of great information here. Check out the chart book. We're always here for you. Hit us up. Any questions? Thanks a lot. See you next time. Bill Baruch is the founder and CEO of Blue Line Capital. All opinions expressed by Bill and podcast guests are solely their own opinions and are not intended to provide specific advice or recommendations. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Understand your financial condition before investing. Blue Line Capital, its staff, or its clients may maintain positions in the securities discussed in this podcast.